It's Tom Asbury with the Viper Report Market Wrap video for the week ending February 6th. And the first week of February has been quite a roller coaster, as has much of the year so far. In the past, say 6 weeks or so, I've been moderately cautious on the market, though the AD lines were pointing higher. I didn't take as many long positions and let the ones we have ride. That means fortunately, we picked those ones well, but we also missed some. Part of the reason for that is what I see in some of the longer-term sentiment measures that are often very well handled by the Bank of America Global Research Group. They do these fund manager surveys. We've talked about them before in the past. And in January 20th, this is the most bullish FMS since July 21. Global growth expectations surge. Cash levels at record low, 3.2%. Typically, anything between 4 gets you pretty nervous. So that's one of the reasons I've been nervous. And no correction against equity correction, lowest since January 18th. Well, those of you who've been with me for a long time know that that was just the start of the year. The market rallied up until about January and then got creamed until May, rallied back into September, and then had one of the worst quarters in many years. So hyper bullish readings for most of these things, higher than normal risk-taking 4-year highs, net 48%, most in 8 years. All of that is something that has me thinking, but the market has been extremely resilient. Let's look at this last week. This is a lineup we don't often see. For the week, the Dow Transports led the way, up 8.7%. That's normally an indication of a strong economy, and it, like the Dow, has continued to make new highs, so no Dow theory sell signal there. Industrials, not far behind, 2.5. Gold, 2.3. And what we've noticed in the past several weeks is the New York Composite. They normally lag, the more volatile and leveraged markets like the S&P and QQQs, but they've been leading for a number of weeks, up 2.2%. The Russell, small caps had another good week, up 2%. And then the losers, S&P, utilities, and the NASDAQ 100, down 1.8%. Look at some charts like this monthly chart of the NYSE Composite. You can see it has this trading channel going up back to, to COVID days in 2020. And, the R1, the yearly R1 resistance is at 24,184. So that's about 1,000 points below or above where we are right now. So got some upside here, but really no signs, of consolidation. Remember, in 2021 we had this sort of monthly action. We moved sideways to drifted lower. That's still a concern of me because of the cash levels, but certainly the way we finished the week and the AD numbers looks like we're going higher first. You can see the RS almost always, never, or rarely I should say, is the NYSE Composite leading the S&P, but it just crossed back above its moving average, and the unbalanced volume is quite strong. Of course, one of my other concerns has been the plunge in the crypto markets. Typically, this has some spillover into the U.S. equity markets. You can see at 24, it was corrected pretty for the good part of the year. Then we had this sharp rally. But this, we wrote something in Barron's, I think, right around in here about how it looked toppy. At that point, it was bumping into the yearly R1 resistance. And, it opened the year below the yearly pivot, and that's still negative. Probably getting sold out, a bit like the software stocks. Very, if we have Stark bands here, hang on. You can see adding the Stark bands onto Bitcoin prices, we have a combination of right back in here in October. We were a little bit early in the top there. We made one more failed push and hit that resistance again up close to the Stark bands, now well below the Stark bands. Hasn't happened a whole lot of times, and so that suggests that at least we're in the territory where a bounce is becoming more likely. Another area that's overdue for a bounce is the IGV. That's the expanded tech software sector. Also had classic sell signal here. And the 20-week moving average started rolling over. The pivot here, is it hit the R1 in October, November, and has been heading the other way south. Even though the New York Composite has been leading the S&P recently, both AD lines on a weekly basis have made further new highs. And that's the main difference. And most notably, the QQQ on a weekly basis, as I said, it was down about 2%, dropped below the 20-period EMA. Did not close below it, but very near, a couple of points just above it. So that's certainly, we're watching this. The tail on the Qs do suggest that there was some buying in at those lows, and so that's a positive for the week ahead. Not so positive is the relative performance here. You can see it's really rolled over and likely topped out. It would need an impressive rally here to get back above this moving average and start a new uptrend. So if we do see a rebound in the growth stocks and in the Qs, at this point it looks like it's going to fail. The market action wasn't quite positive on Friday. You can see this is our 90%, 61% of the S&P stocks were higher. 66%, 67% of the S&P 1500, and even 54% in the Qs. That's the best we've seen in a couple of weeks. The daily AD lines are looking pretty strong here. We've been talking about for a while that we had this period of consolidation and we broke out, and we should see more on the upside. Really haven't got a lot. It's been just kind of grinding higher, but some of the sectors have been doing quite well. So the S&P AD line has a nice little bullish formation. It was strong on Friday, turned up, new high. Stocks only, new high. NYSE, new high. On the daily chart, you can see we closed back above the pivot in the SPY. It's a great sign. We get down the S1, tested the 100-day moving average, and so now we should be heading towards the 701 R1 for a monthly basis, if not the R2. Not a lot of put buying going on here lately, but the bearish sentiment has been building. So if you look down here at the bottom, you can see another shot at the AD line. Pretty impressive surge. The VIX and the VXN looked like they were going to potentially bottom in the early part of last week, but and that's still a possibility. So we've seen, we have a pattern of, or rather, higher lows and higher highs. So but so far every time we look like we're going to move higher, we reverse. So I'll be watching that this week, and of course we'll update on Twitter, etc. Some of the sectors that have been working well, the small cap, I think we finally got a resolution there. It's been jerking all of us around for the past couple of years. Remember in late 2024, it looked pretty good here, formed a doji sell signal, and went from 125 down to 88. So looking much better with its last close, up 3.4%. So we're holding on to longs there. We do think that this may be the year for the small caps. If so, it could get as high as 148. And our growth value keeps dropping. That means value's leading. Broke the uptrend here. Still starting to get, a little oversold here. You can see the MACDs on the bottom. So, you look at this peak right in here, and where we were in early 25 as the market corrected. So that's kind of where we should be seeing a bounce here. I would say, either if not this month, early March. And you can see that the gap here between, the moving average, the 20-week, and the spread is quite wide. Wider than it was here in early 25. Wider than it was here in 22 and 23. So if the NYSE composite means that value has created, a significant bottom like it did after the dot-com top in March of 2000, then any rebound in value should be an opportunity, or a rebound rather in growth should be an opportunity to reduce holdings there, and also a correction in value should be a buying opportunity. In that other scenario, and I'll be writing something up about that shortly, as the NYSE composite started leading in 2000, 2001, overseas markets also took hold. So that's an interesting play. Some things I'm looking at for the week ahead. You can see this is a chart of the QQQs, which are cap weighted versus the equal weighted. You can see in the last week or so, the equal weighted has just plunged. You don't see that, in the normal QQQ, because of the weighting. Down below here, you can see this, not too easy to see, in green is the MSI minimum volatility shares, the USMV, which it also is looking pretty interesting. A pretty solid play if we do have choppy trading for the rest of the quarter and swings both in value and growth. This one should have but limited downside too. Another area the market is has been very strong. The Dow Industrials. It's also kind of viewed as a more value index. You can see we had these highs here, just surged above it on Friday, up over almost 2.5%. Down below here, we can see the relative performance. It also indicates the Dow is leading the S&P. Doesn't happen all that often. And of course, the Dow AD line here is screaming to the upside. So that's also an interesting highlight for the week ahead. One of the few negatives, and it was certainly concentrated once again in the NASDAQ stocks, is that the number of new lows surged above 500 on Thursday. So a minor breakout here. It was 228 on Friday's action, but you can see we still have another lower high in the number of NASDAQ stocks making new highs. In the T&J watch lists, ETFs, there were some new weekly sell signals in a couple of markets, so we'll have to see reverse next week. The ARKG, the QQQ, the SOCL, that's the global social media, the TQQ, which is the leveraged Qs, and then VCR and XLY, both consumer discretionary. We're out of those because we didn't really like the action, and we also were watching closely XLC, what they're out of. AIQ also turned negative. On the plus side, we had the USMV we just recently talked about, and QID, which is an ultra short QQQ. 72% of the ETFs are positive. That's a good sign. Growth 40% positive. Value 100%. So we'd like, as I said, we'd probably see some switching in that in the next couple of weeks. The short and long, the DTS, on the short ones is positive for anything other than the small caps. Positive signals in some of the bank stocks, JPM, WFC, 3DTS, though the weekly is still negative. Airlines have been screaming, so that's positive across the board here, and gives you a good idea of what's likely to be leading. Materials also is acting well. Energy looks very good. We actually took a position, XOP. We haven't traded it much the last year or so, but so far this one's working out okay. Materials, very positive. Industrials, also very positive. Not a lot of new positive signals here. So CTVA, is negative, so we may look for a switch there. Consumer discretionary, RS chart does not look very good. And, consumer staples looks great. No surprise there, 100% bullish. If you go down into healthcare, it had a good week, and I still like it longer term. Looks like, as I said, some of the pharma, components of healthcare may take over leadership for a while. Financials, 36.4. I think this may be a sleeper. We're still trying to see some signs of a bottom there. We've got closer to the yearly pivot, but not quite. Technology, it looks, pretty much overdone down in here. So I wouldn't be XLC communications, it's at 50%, so it's right on the benchmark there. Utilities are acting a little bit better, 83.3, and the REITs, due to yield requirements, are looking much better now, 66.7. So they're a nice sort of safe place to be, I think, in a lot of respects. You can see there's a number of them that in the farm that, EQIX is positive across the board and just gave a new daily buy. And there are a couple of health REITs also that had some nice looking charts. Later today on the Viper Report, we'll have new positions updated. And also I'm going to start trying to put the charts up from Twitter up on the site so that you can see what that. Once again, Jerry had a very interesting article. If you want to try to understand gamma, I think this will help you. And we're still, while we're locked into the snow banks, we're still doing teaching on advanced decline analysis. A fairly attractive offer, about 38% off. And I think if you're interested in really understanding the stock market as well as making your trading or investing better, if you want to really understand the stock market and also improve both your trading or investing performance, I think you'll be very pleased after you complete this course. Thank you very much. Touch base next week. Comments and questions, Tom@viperreport.com.